What's up guys, Nick here, back with another video. If you're tired of buying stocks that keep losing you money and you're frustrated because you have no idea what you're doing and why you keep losing money, then this is the video for you. In this video, I'm going to show you what you should be doing before you buy any random stock, how to tell if a company is actually worth something or totally worthless, and the best part is I'm going to show you how to do it quickly and easily from just the phone in your pocket. Okay, so the first thing that you need to do is to download the Yahoo Finance app. What I'm going to do is I'm going to pull up 3 popular stocks that I hear talked about a lot so that you guys can see some of the differences. Alright, so let's take a look at some of these companies. We're going to start out with Genius Brands International. Let's hit the details. We're going to hit the financials. And it'll start us out with the income statement. It looks like they had $5 million in total revenue. And it looks like they ended up with a $12 million loss. Let's go over to the balance sheet. Have to switch to quarterly. We'll go down, take a look at their assets. It looks like they had $34 million in assets and they had $30 million in liabilities. If you take the assets and then subtract the liabilities, that gives you $4 million in equity. Let's compare that to their debt. Looks like they had only $2 million in debt, so that's a pretty good number. $2 million in debt to $4 million in equity. Let's take a look at their revenue and earnings for the past 4 years. So it looks like in 2016, lost a whole bunch of money. 2017, lost a whole bunch of money. 2018, they lost a whole bunch of money. And in 2019, they also lost a whole bunch of money. So that's not too good. Let's take a look at the summary. And we're going to scroll down and we're going to see the market cap. The market cap is basically the total valuation for the business right now. So if you took all the shares and added them up together at the current share price, you'd get the market cap. So right now, if you bought this stock at $2.23 per share, you'd be paying an equivalent market cap of $485 million. So you have to decide if that's worth it. In my opinion, there's no way I would pay nearly $500 million for a company that's earnings look like this. I just don't see how it really makes any sense, but I don't know anything about their business. So you'd have to really convince me that it's worth $500 million, and I'd be pretty skeptical of anything that would really say it is. So the next company we're going to take a look at is a big company that has been in some trouble recently. It's pretty interesting when we take a look at their balance sheet, what's actually going on with them right now. So let's click on Boeing. Boeing Company. We'll hit details. And then we'll hit the financials, view all. Alright, so it looks like their income statement looks like they had $70 billion in revenue, but they ended up losing $3 billion. So that's not good that they're losing money. Let's take a look at their balance sheet. We will switch over to quarterly. Looks like they had $143 billion in assets, and they have $152 billion in liabilities. So that's a problem right there, that they have more liabilities than they have in assets. So let's just scroll down real quick and take a look at the equity. So you see that in minus $9 billion in equity, and that's because the liabilities are so much bigger than their assets. And then let's look at their debt. So their debt is $33 billion in debt, and that's long-term debt. Their current debt, that means debt that they owe in the next year, is $5 billion. So this is a problem. They have a lot of debt, and they have no equity left. And on top of it, they're losing money. So that's not really a good situation to be in right now. Let's take a look at their past 4 years. It looks like they had $93 billion in revenue to $5 billion in earnings. So they made a little bit of money there. Looks like 94 to 8, so made some money again, a little bit more. And then it looks like $10 billion. So they made a little bit more money there in 2018. But then last year was the bad year, and they lost $500 million. So if we go back and let's take a look at the summary again. So here's the market cap for Boeing. It looks like they are trading at $99 billion for a market cap. So what you need to ask yourself is, with all of the risk of their balance sheet, the fact that they have more liabilities than assets, they have a ton of debt, and last year they lost money, but if things get better, potentially they could make money. I don't know. To me, it seems a little risky. We kind of have to figure out what's going to go on with Boeing in the future. Personally, this is too much risk for me to be interested in investing in. I feel like there's a good chance that if you were to buy it at this price at $100 billion, that there's a good chance that it could go down for the next couple of years, and you might not end up really making much money off of it. I think there's probably better buys out there than Boeing right now. All right, and the last company we're going to take a look at is Google. Oops, I typed in too many O's. Google right there. All right, so same thing again. Hit the details, financials, view all. Looks like they had a whole lot of revenue, $166 billion in revenue, $34 billion in net income, so that's good. They're making money, and they're making a lot of money, $34 billion. It's a pretty high margin. Take a look at their balance sheet quarterly, and we'll scroll down and take a look at their assets. So they have $273 billion in assets, and they have almost $70 billion in liabilities. So that's a pretty big difference between their assets to their liabilities. That gives them $203 billion in equity. So that's fantastic. And we see with that, they only have about $4 billion in long-term debt, and I don't see any current debt listed under the liabilities. So that's even better. It means they have almost no debt to their equity. Let's close that out. All right, so let's take a look at the past 4 years. It looks like they were earning $90 billion of revenue in 2016 to almost $20 billion in earnings. Looks like the following year that went up to $12 billion in earnings, $110 in revenue. Kept increasing, $136 billion in revenue to $30 billion in earnings. And in the last year, they had $161 billion in revenue to $34 billion in earnings. So that's fantastic. You see the revenue consistently growing every year. You see the net income. It looks like there was a down year, but I think this was the year that they took a big fine from the European Union, and then it just kept going up. So this is a good thing to see. So let's take a look at the summary, and we'll scroll down to their market cap. So right now they're trading at $1.03 trillion. So the way that companies like Google are valued is off of something called their PE ratio, okay? So the price to earnings ratio. And that basically means the current share price divided by the earnings per share. So the amount of net income per share they made over the last year. So we can see that Google has a share price of $1,512 per share, and they earn $49 per share. So if you divide that, you end up with a PE ratio of 30. In my opinion, this is a pretty good number. I'm not going to get into how to calculate these numbers in this video. It would just make everything a little too long. But if you look around, look at these PE ratios and kind of get a feel for what different types of companies will trade at. Some companies like utility companies and banks will typically trade around 10 to 15. Tech companies tend to trade higher. I think Amazon's at like 123 right now. So keep an eye out for the video that I'll make on PE ratios. Okay, so that's a very quick overview on how to do a quick valuation on a company. Obviously, there's a lot more involved if you're doing a full valuation than just looking it up on Yahoo Finance and checking out the past couple of years. Thanks for watching.